Hi, I'm Kris Kellinghaus, Chief Investment Officer with MCF Advisors. Today we're going to provide a brief update on economic activity, Fed policy, and an outlook on earnings and GDP growth going forward. Let's start with inflation. About a year ago, we posted an MCF Perspective Moment walking through a scenario of inflation rolldown, and that's exactly what happened. Last June, inflation peaked at 8.9%, the highest year-over-year reading since 1981. April's reading was 4.9% for headline inflation, but 5.5% for core, which excludes the volatile components of energy and food. The bottom chart looks at month-over-month numbers. We see a much tighter range of inflation readings over the past several months. Both core and headline inflation for April were 0.4% month-over-month. As long as inflation stays around this range over the next couple of months, we expect inflation to get closer to 4% or less by the end of next month. But it's important to remember that inflation comes in waves. This chart looks at calendar year inflation back to 1950 and provides averages for each decade. Of course, the highest inflation average was 1970s at about 7.4%, with a peak annual inflation of 13.3% in 1979. Last decade was only 1.8% average inflation per year. So far this decade, we're averaging about 4.9%. We expect this number to continue trending lower, but likely this decade will end up higher on average than the prior decade. With inflation moderating, let's take a look at the labor market. This chart shows three different graphs representing the strength of the U.S. labor market. You can see the pretty wild swings that we saw during the pandemic, but luckily we've recovered well. Currently, we have more job openings than we do unemployed workers. The labor participation rate is close to 63%, near pre-pandemic levels, and the non-farm payrolls continue to post strong numbers above 200,000. So with inflation moderating and the labor force strong, let's take a look at Fed policy. Over the past 14 months, the Fed has used interest rates to try to fend off inflation. However, a lesser discussed Fed tool is the money supply. During the pandemic, the Fed flooded the market with excess money, right? We saw a year-over-year increase in money supply of nearly 27%, more than double the prior high. However, the most recent reading is negative 4.1%, so a decline in the supply of money. The Fed is pulling money out of the economy to try to fight off persistent inflation. The chart on the bottom looks at the level of money supply along with velocity of money. Velocity of money times the money supply equals GDP. Generally, the higher velocity, the higher the economic activity. We saw a significant decrease during the pandemic, and that number is recovering, but likely it won't recover enough to offset the significant decline in the money supply. So given the Fed policy, let's take a look at consumer strength. Households across the country remain strong. This top chart looks at debt as a percentage of disposable income along with the U.S. savings rate. Again, we see some pretty wild swings during the pandemic, but these numbers have come down. The Fed flooded the market with money. U.S. savings rates went up, but we've seen consumers spending down their savings over the past couple of years and are currently only saving about 2.7%. This number seems to be close to hitting a trough, and we expect this number to start climbing back up over the coming years. Debt as a percentage of disposable income is also well below the peak we saw during the Great Financial Crisis of 13.2% and below the historical average of 11.1%. The bottom chart is another measure of household strength. This shows the total net worth of households across the country. Peaked at the end of 2021 as the Fed had padded savings accounts and the stock market peaked. This number's come down a little bit, but it's still at an attractive level. So in terms of consumer spending trends, this chart goes back to 1947 and shows that consumer spending on average has been about 3.4%. The red bars indicate periods of recession. We can see that consumer spending typically dips along with recessionary periods. However, Q1 GDP readings show consumer spending at 3.7% for the quarter. This is above historical averages, but the next three quarters are expected to be very low, flat to maybe up 0.4% for the next three quarters each. This is an indication that economic activity is slowing, and unfortunately, the other components of GDP growth, especially private investments, which is expected to decline this year at 2.7%, are not going to provide enough to offset the slowing consumer spending. Likely, we will see a quarter or two of negative GDP this year. So let's look at GDP forecasts. GDP forecasts for 2023 on the year are 1.1%. This number falls to 0.8% for 2024, but pops back up to 2% for 2025. This is in line with expectations that the next couple of quarters will be weak, even though we saw a reading of 1.1% for the first quarter GDP. The bottom chart looks at GDP growth all the way back to 2017. Even though we had a significant dip during the pandemic, we've averaged about 1.9% GDP growth since 2017. Now we turn to corporate earnings as another gauge of consumer spending. This chart looks at annual earnings on the S&P 500, along with the bar at the top representing the forecast for the next year's earnings growth. 2023 is expected to be pretty weak. Many analysts project earnings growth this year to be flat. Some project an earnings recession of about -3%, and still some project a positive earnings growth for the year. However, the bright spot for corporate America is that revenue growth is strong. Costs are up, that balances off to weak earnings growth for the year. But the picture for 2024 is much brighter. Forecasts for 2024 earnings growth are about 20% higher than they are for 2023. If we look at both GDP for 2024 and 2025 and corporate earnings for 2024, this indicates that the consumer is strong, likely will be able to get through a mild recession fairly unscathed, and get spending back on track starting with 2024 and into 2025. We do not project any kind of gloom and doom scenario that we saw in the great financial crisis or the deep drawdown in the economic activity that we saw during the pandemic. So in closing, we'd like to just reiterate that inflation is moderating and we believe it will continue to trend lower. The labor market is strong and has some room to weaken. Fed policy is restrictive with higher interest rates and decline in the money supply. Consumption remains robust with healthy households. GDP is weakening, but we believe the consumer will get through most of the next few quarters of slow GDP fairly unscathed, and earnings will remain resilient, mostly flat for this year, but potentially up 20% in 2024. We've made a couple of adjustments to portfolios to absorb potential for various situations that could arise. And as always, we prepare, we don't predict. Thank you.